Financial markets mark time after a scary start to the month of September. Yesterday, Wall Street had its worst day yesterday since that August 5th debacle where volatility spiked across markets and sent everybody scrambling. So, not exactly the most auspicious start to the month. But today, things basically held steady. The absence of a lot of meaningful news flow to chew on apparently left the markets without much impetus to go very far this or that way. But that ends now because we are about to get the first batch of really heavy duty U.S. economic data hitting the wires here over the next 24 hours, and of course, into the end of the week as well. We'll focus here on that first bit of data in the immediate purview here. This is, of course, macro money. I'm Ilya Spivak, head of global macro here at tastylive, and what we're going to do here is first take a look at this data that's coming at us in the coming day, but really also to try to understand how to look at it and the context with which markets are likely to interpret this data, because really that is much more important than the substance of the numbers. And in kind of shaping our lens here, where I land is that the most likely outcomes on these numbers are almost de facto the scariest for stock markets. And to unpick why, let's first consider the evolving relationship between Fed policy expectations and the stock market. And here we've looked at the stock market through the lens of the S&P 500, big, broad index, obviously something of an avatar for overall equity market sentiment and indeed overall sentiment in general. So we're looking at that here. And in the gray, we have Fed funds futures implied rate cut expectations for 2024. In the yellow for 2025. In the orange is a sum of the two. So let's begin to trace this and see what it looks like. So consider here, we are in late October going into November of 2023. The markets expect between 3 to 4 rate cuts for the total easing cycle through the end of 2025. Most of it in 2024, a little bit of it in 2025. And so cumulatively, we're looking at least 3 cuts, that's 75 basis points, and a slight optionality, about 3 basis points worth of optionality on a 4th cut. This is, of course, an auspicious moment because right here is where the Fed says, at least signals to markets, we are about done with rate hikes, and the next move that we take is probably a cut. This is where that actually occurs. Not surprisingly, stocks find a bottom and start moving higher. At this very moment, the stock of easing starts to expand. In fact, if you notice, from this point to where the bottom is, to where the next top is, to where the next bottom is, where we are now, the cumulative rate cut expectations have oscillated between about 3 cuts, so 75 basis points, and 200 basis points, that is 8 cuts. And that's really been the range that's held now for almost a year. So when the Fed initially makes this announcement, what happens here? you start to build greater rate cut expectations, stocks not surprisingly rise. So there is an inverse relationship between stocks and rate cuts. The more rate cuts, the better stocks do. Why? Well, let's consider where we were in the US economic cycle at this time. Here is October, late October, early November. This is where stocks bottom, right here. Now, that's this bottom here. Now, just as the Fed makes this announcement, late October, early November, what we get is a run of US economic data that starts to deteriorate relative to expectations. And so the market says, oh, the economy is weakening. That means more cuts. The Fed is saying they're going to be responsive, risk on. The story changes when you start the year. As you notice, well, US economic data from about mid-January is improving relative to expectations. And this is a move that stalls around mid-February, but then generally holds up until about mid-April. Well, consider what happens here. As US economic data improves, you, of course, have fewer rate cuts that seem sensible. But this is not bad news for the markets because they go, oh, well, the Fed has to cut even if the economy is improving because inflation is coming down. Inflation realized cooling means inflation expectations are coming down because all those rate hikes that the Fed did in 2022 finally are having their effect. So that means that the real cost of borrowing will go up if the Fed doesn't cut. Nominal interest rates minus expected inflation is how you get to the real cost of money. If expected inflation falls, well, then those real rates are de facto going higher. And then, of course, you run the risk of hurting the economy more than you want as a function of being successful in step one of the process, bringing down inflation expectations. So from the Fed's perspective and from the market's perspective in observing the Fed, rate cuts make sense because you don't want to over tighten. You don't want a situation where your own success at beating inflation gives you soaring real interest rates that then crush the economy. So the markets look at this and say, well, the economy is doing fine, but the Fed still has to cut. There'll be fewer cuts, but this is not bad news. The economy is okay. Stocks keep going higher. Notice you invert this relationship. Whereas here, more rate cuts, good for stocks. Here, fewer rate cuts, not bad for stocks, fine for stocks. This turns mid-April or so. Well, what happens then? U.S. economic data starts to deteriorate again relative to forecasts. And now the markets go, uh-oh, the data is getting sour again. That means we need more cuts. Here we go. And for a while, this is supportive for stocks, just like this was. The makeup of this changes significantly, and most of the rate cuts don't occur in 2024 as they did here. Now they've been pushed out to 2025 because just as all of this is occurring, the Fed is saying inflation isn't falling as fast as we want. It's been kind of sticky in the second quarter coming out of the first. We're maybe only going to do one cut this year. And the market is saying, no, you need to do cuts. And as the Fed resists, you can see the outlook for this year holding steady. All of the dovish expansion occurs in 2025's outlook, because here is where the markets say, you're going to have to catch up. You're already falling behind on growth. You already need to cut and should be cutting, but you're not. So that means you're going to need to cut more. Notice we go from, once again, 3 cuts, a revisit of this level. By the end of June, so before this sell-off, to almost double that at 133. So the markets clearly think the Fed, over the course of about 3 months, has fallen behind the curve. Why? Because this entire time that the story on U.S. economic data is getting worse and worse and worse, and ends up being ultimately worse than it was here. Because we actually get underneath 0 on this Citi U.S. Economic Surprise Index, which suggests not only is data losing its capacity or the margin by which it surprises higher, that's any numbers above 0, now it's actually surprising lower. That's a move under 0. So U.S. economic data as of end of April going into May is actually starting to tend toward not just smaller beats, but outright misses relative to forecasts, and the quotient by which it's missing appears to be growing. So not surprisingly, the market's reason, wait a minute, the Fed is behind the curve. They're going to have to cut more. And then the breaking point occurs again in July. This time because the Fed actually says, you know what? Yeah, you're right. It's time to start cutting. And then the market says, wait, oh, now you think it's time? Well, you've been falling behind the curve for 3 months as far as we're concerned. So if now's the time, then you have ostensibly perceived something in the economic outlook that is so intolerable that you've been summoned into action. And we flip again. And while here, fewer rate cuts was perfectly fine for stocks, now more rate cuts is bad for stocks. These things have started to move in lockstep again, not inversely, only this time not up together, down together. Implying that the Fed's now response, its willingness to move on rates imminently, signals after 3 months of what the markets appear to think is falling behind the curve as responsive to recession risk. Now, we saw some endorsement of this with particularly bad U.S. jobs data right here. Markets saw some panic, fell. They've since rebounded as the panic abated, and very tellingly, did not reclaim the high and did not reprice Fed policy in any kind of a meaningful way. The same sort of pinning around the 2% in cuts for the cycle that were there near the bottom of the panic here, they've mostly held. And so this then is where we are left. As we head into September's meeting, the odds of the scenario where the Fed says, the economy is fine, we're not too late, we do need to start cutting, but this is more maintenance to make sure we don't over-tighten rather than some kind of an emergency, that school of thought, one cut, has a 55% probability of occurring according to Fed funds futures, and the we should have cut in July, we're late, we've fallen behind the curve, we need a double-sized 50 basis point cut, that has now a 45% chance of occurring. So this is essentially a coin toss, which creates immeasurable volatility potential given this uncertainty and a lack of conviction. It is then this economic data that we are facing this week that sets us up for a resolution, and one way or another, a bunch of people in one or the other camp here might look wrong, creating volatility. In the immediate, the first thing that we're looking at here, and we'll get to the U.S. jobs report, Friday's release in tomorrow's conversation on macro money. Definitely come and check that out. The first bit here comes from the Institute of Supply Management, ISM, and their monthly economic surveys. This time we're going to get the manufacturing numbers having been out, the service sector version. And what we're looking for here is for things to hold basically steady. There was a shock slip below the key 50 level in June. That's the dividing line between expansion and contraction of economic activity. Above 50, economic activity is expanding. Below 50, economic activity is contracting. The further you go above 50, the faster it's expanding. The further you go below 50, the faster it's contracting. So we had a shock contraction in June. We rebounded from that in July. And the expectation is we're going to hold relatively close to July's level and basically sustain the situation. We saw manufacturing numbers come out earlier this week. They disappointed by a very narrow margin, 47.2 versus 47.5 expected. So a little bit of a faster contraction in manufacturing than anticipated. And if we look underneath the surface here, what we're looking at is the kind of situation that might give the Fed some trouble. Because on the one hand, we have new orders and employment going the wrong way. So actual business activity seems to say we need more rate cuts, whereas the prices component is rebounding, seemingly saying, wait, inflation concerns are not completely off the radar. That seems like the kind of thing that, again, lands us into this sort of purgatory. But of course, manufacturing is a much smaller part of the economy than services. Services accounts for close to 3/4 of U.S. growth. So, and something on the order of 80% of U.S. employment. So the numbers that are now ahead of us are much weightier for the Fed's ultimate calculus. Helpfully, we've already seen the S&P Global version of these numbers, and the story is an interesting one to set the stage. We have seemingly solid numbers. Service sector holds up here. The composite dips a little because manufacturing is anemic and goes deeper into contractionary territory. Commenting on this, chief economist at S&P Global says, on one hand, solid growth. We probably have GDP growth in excess of 2% in the third quarter. That should allay near-term recession fears. However, this soft landing scenario looks less convincing when you scratch beneath the headline numbers. And the main highlight here is that growth is becoming increasingly dependent on manufacturing, which often leads the economic cycle, which is to say this is a problem because this anticipates something similar over here later. We also see that service sector growth is being constrained by hiring difficulties, which continue to push up pay rates and means overall input cost inflation remains elevated. And the policy picture is therefore complicated. Hence, it is easy to see why policymakers are taking a cautious approach to cutting rates. In other words, as we look at this release and say, well, we could have numbers at the headline that maybe are give or take in line with expectations, and indeed, this is the likeliest result, almost by definition, because these forecasts are the product of polling a vast array of banks, research houses, brokers that have their models for generating these forecasts, taking that vast array, distilling out of it a median, which is usually done by the likes of a Bloomberg or a Reuters, and establishing the forecast there. There is a lot of under the surface thinking that goes into generate these numbers. And so the outcomes almost invariably are likely to register closer to expectations. The dynamics here suggest, in fact, that we've seen some recent anchoring around the relationship between stocks, or between economic data, rather, realized and economic data expected. And so you get the sense that a print within what is becoming the normal, quote unquote, bound for data surprise, that this is the likeliest way forward. But of course, that's also the scariest sort of proposition for stock markets, because it doesn't resolve this disparity. Were there an upside surprise, the markets would say, we don't need a 50 basis point rate cut. Growth is fine. 25 is okay. Good for sentiment. Were we to get a downside surprise, the markets might say, oh, well, this locks in a 50 basis point rate cut. We're going to get the support we're looking for. The Fed will catch up. Again, positive sentiment potential there. But if instead we end up with something broadly in line with expectations, with this kind of backstory under the surface, as the S&P Global version of the data argues, well, then we might very well be right back here, where the market says the Fed can't be sure if it's behind the curve or not, but we think it is. And given uncertainty, they are likely to take the most measured path and so perhaps fall even further behind. So the growth story isn't what we wanted, and the Fed is not responding to it as quickly as we'd prefer, making for a risk-off outcome for markets that also comes out to be also the most likely, just relative to where expectations sit. And that is Macro Money for today. As ever, we are here every single week, Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things might go from there. I'm also on with Victor Jones for The Price of Truth on Wednesdays. That's today, just 30 minutes after we wrap things up here. Definitely come and join for that. I'm also on with Chris for Futures Power Hour on Fridays, on with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter, at Ilya Spivak. Thanks very much for joining. See you tomorrow.